Right? Today, under financial statement analysis, we are going to learn the common size analysis. Here, we are going to cover the purpose of the common size analysis, types of common size analysis, advantages, disadvantages, and how we are going to prepare the common size analysis and how we are going to interpret the common size financial statements. Let's look at the purpose of the common size analysis. So here, the common size analysis is a tool that financial managers use to analyze the financial statements. It creates the common size financial which make it easier to analyze a company over time and compare it with the peers. So using these common size financial statements, it enables the investors to spot the trends, right, by using the raw financial statements, and they can discover what are the changes and what are the reasons due to the changes in the common size analysis over the period. So let's see the types of common size analysis. The common size analysis can be conducted in two ways. First one is the vertical analysis. The other one is the horizontal analysis. Vertical analysis refers to the analysis of the specific line items relation to the base item within the same financial period. The vertical analysis of the balance sheet or the statement of financial position means every amount in the balance sheet or the statement of financial position we have to take as a percentage of total asset. And the vertical analysis of income statement use the sales. Here we have to take the net sales as the base, and all the other components of the income statement are shown as the percentage of sales. So, in the vertical analysis, what we are going to take? For the statement of financial position, we are going to take the total asset. Then we are going to see what is the proportionate of each item with the total asset. Then we are going to take the income statement. Then we are going to identify what is the proportionate change comparative to the sales. Now the next one, that is the horizontal analysis. Horizontal analysis refers to the analysis of specific line items, right? Specific line items, compare them to similar line items in the previous or subsequent financial period. So this horizontal analysis is known as the comparative analysis. Why it known as the comparative analysis? Because here we are going to compare the current financial year with the previous year or the forthcoming or the future financial period. Just take 2022 financial year. Then we are going to compare 2022 financial year compared to the 2021 as well as compared to the 2023. So, this horizontal analysis also known as the dynamic analysis as well. Because here we are going to identify the changes or the key changes over the period of time for particular item. So then, let's see what is the common size statement of financial position analysis. As I mentioned you earlier, here the common figure for common size statement of financial position analysis is the total asset. The common size strategy from a statement of financial position, right, perspective lends insight into the firm's capital structure and how it compared to the rivals, which means from the total asset, we can see what is the portion for the equity. Comparative to the total asset, we can see what is the portion for the non-current liabilities. So we can have idea what is the proportionate change of the company itself when compared to the same years, as well as we can compare it with the industry rivals or the competitors. So we can see what is the structural change in the capital structure of that particular firm. So it is used as a tool to identify the changes in the capital structure. So the next one is an investor can also look to determine an optimum capital structure for an industry and compare it to the firm by analyzing. So what is this optimum capital structure? So since you are going to do the strategic financial management, you know that Modigliani and Miller have the optimum capital structure theories. So this optimum capital structure may vary from the industry to industry. So in the Colombo Security Exchange, they have the industry averages. So you can compare your company's capital structure with the industry analysis. So with the industry, you can identify what is the industry average. You can compare whether our company is in line with the industry, or are we are going to back with the industry, or we are as a benchmark for the industry. So you can compare and identify and determine the optimum capital structure for the industry, as well as you can compare it with your organization or the firm. Further, it may enable to conduct and conclude whether the debt is too high or the excess cash is being retained in the statement of financial position, or inventories are too high. So how we are going to compare? So we know that in the statement of financial position, we are going to compare each and every assets and liabilities comparative to the total asset. So we can see what is the proportionate of the debt compared to the total asset. So by comparing with the industry as well as compare with the firm with the previous years, you can identify whether our debt is too high or whether it is satisfactory. So at the same time, we can see the cash in hand and cash at bank balances. So we can see whether we have retained more cash in the firm. So you know that there is a theory behind liquidity and profitability. So if we retain more cash, what happens is we haven't utilized that particular cash to earn the profit. In that case, our profitability may be hampered or deteriorated. Therefore, what you have to do is you have to improve the cash balances marginally to earn the profit. In other words, what else can be happen? If we have retained a minimum cash balance, sometimes they may be not to repay the creditors or accrued payments, which means we are unable to cover up our current liabilities. In that case, the company's position and performance may be restricted in future. So you have to see whether we have the excess cash or whether we are having a minimum cash balance in the statement of financial position. At the same time, inventory. So we know that if a firm is good, then the inventory turnover should be high, which means from each inventory in the stock, we have to generate sales out of it. But if we have more inventories, it will good for the liquidity ratios. Current ratio may be high because of the high inventories. However, what will happen to our profitability? If we are retaining too much inventory, then sometimes these inventories holding cost may be up. So it will be an additional burden to the firm. And on the other hand, if we are holding too much inventory, sometimes there may be pilferages. Sometimes there may be obsolescence. So we have to have a proper inventory management system. Otherwise, company's profitability may be hampered because of these too much of inventories in our warehouse. So we have to check what is the inventory and what is the proportionate of it as a total asset. So we can compare it with the industry as well as with the previous years and identify what are the changes behind it. Then the goodwill level on the statement of financial position also helps and indicate the extent to which a company has relied on acquisitions for growth. So if we have a growing goodwill level or accelerated goodwill level, then we can see we are in a good position. So if we are going to acquire another firm, then this will be a positive advantage. On the other hand, if we have a good goodwill, then we have a bargaining power when it comes to takeover. So with the higher goodwill level, competitors may be less attacked to our organization. It is attacked, not the attract. Most of the competitors will be attracted to the firm because of the goodwill, but they may be less attached to the firm because of the high goodwill. They have to pay higher fair value to acquire the firm. So let's see the next one, that is the common size income statement analysis. The common size income statement analysis is an income statement in which each line item is expressed as the percentage of the value of the revenue or sales. The common size financial statements help to analyze and compare companies' performance over several periods with varying sales figures. And it makes it easier to see what's driving the company's profit. So they can see each and every item in the statement of income, and we can see what is the proportionate of it as compared to the sales. So let's see. First, we are coming with the sales, then we have the cost of sales, then we have the gross profit, then we have the other income, we have sales and distribution expenses, admin expenses, sometimes financial expenses. Likewise, you can see the key items in the income statement. So we can see what's driving the company's profit. So first we'll take the gross profit. If we are going to take the gross profit is mainly depend on the cost of sales and the sales. So if we are going to compare everything comparative to the sales, the main driver affect to the company's profit is the cost of sales. So you can see compared to the previous years, what is the cost of sales as a percentage of sales. Then you can see whether the cost of sales percentage has been increased or decreased in the vertical analysis. Then you can see what are the reasons behind it. Then after the gross profit, you can see other income. Sometimes in the particular years, the other income may be increased, but comparative to the sales, it may not be increased or it may be stagnant. So then you can see the sales have a direct impact on the other income in that particular company. If not, you have to see what are the reasons behind it to increase this other income or to decrease this other income. Then you have the expenses. So the expenses have a major impact on the net profit. If the expenses are increased comparative to the sales, normally our net profit will be decreased. So you have to see what is the proportionate as with the sales, and you have to identify what are the reasons behind it. I'm moving to the next point, that is the common size percentage can be subsequently compared to the those of competitors to determine how the company is performing relative to the industry. So you can see because of these increase in the import duties, taxes, as well as exchange rates, cost of sales may be increased in the overall industry. So when by comparing with the competitors, you can see whether we are in line with the competitors or are we spend more money in the cost of sales and what are the reasons for it. Then you can say the administrative expenses and other things. So in the industry, if there is a change to the salary scales, then we know that our administrative expenses may increase. But this can be only identified by the comparative analysis. So this is a broader area. You have to go line by line and you have to compare it with the industry to identify the clear reasons for reason out the vertical analysis. So let's see what are the advantages of common size analysis. So as I mentioned you earlier, it can be used to intercompany comparisons to compare with the different companies with different sizes. Why we can compare with the different sizes? Because for each company, we are going to take the vertical analysis in the income statement compared to the sales. Vertical analysis in the statement of financial position compared to the total assets. So whether it's a blue chip company or a big company or whether it's a small company, we are going to common size or we are going to comparative statements. We are going to prepare the comparative statements by using this method. So then it's easy to compare the companies with the different sizes. Then next one is very effective in understanding key trends over the time. So by compared with the previous years, we can identify what are the line by line changes. So we can identify whether there is a particular pattern, then there is a particular trend over the time. Then next one is helpful in analyzing the structural composition and how that structure is changing over the time. So you know that here we are going to compare each and every item in the statement of financial position and the income statement line by lines. Sometimes there may be new items. As a result, we can identify whether the structure is changing or not. So if I am going to take the income statement, if the previous years, if we don't have the other income, and in the current year, we have a new item called other income, it can be easily identified with this common size analysis. If we take the statement of financial position, if we have the revaluation reserve in the current year, so we can clearly identify it as a new item in the vertical statement of financial position. So we can identify whether there is a structural composition change. Then the fourth one, most effective way to compare company's financial statement to the industry average. So as I mentioned you earlier, this common size analysis can be done in different size companies in the different sectors as well as different industries and the same industry. So then it's easy to identify the industry averages by going through the industry. So then it's easy to benchmark. So final one, it helped to reveal the missing drivers. Missing drivers means if we have missed out something, it's easily identified by comparing with these line by line items. So let's see what are the disadvantages of this common size analysis. It does not help to take decisions since there is no standard ratio or percentage regarding the change of percentages in the various components of assets, liabilities, sales, etc. So you know that in the ratio analysis, we have some norms. What are the norms? We have a norms for current ratio, that is 2 to 1. We have a norm for quick ratio, that is 1 to 1. But here we don't have a standard ratio or a percentage. So then there is an issue of making decisions whether we are in line with the standard or not. So that is a disadvantage of the common size analysis. Then the next one, does not recognize the changes in the price level. That is inflation effect. So it supplies misleading information since it is based on the historical cost. We know that all the financial statements are based on two concepts. First one is the entity concept. The other one is going concern concept. Because of these major two concepts, each and every financial statement is prepared based on the historical cost. Actually, we know that this historical cost is irrelevant for decision making. For decision making, we have to make the decisions based on the relevant cost or the current cost by identifying the inflation effects. So, but this common size statement analysis is unable to identify the changes in price levels. Therefore, the decision may not be accurate with this common size analysis. Let's move on to the third one. If consistency in the accounting principles, concepts, convention is not maintained, then the common size statement become useless. So what are the principles? So you know that we have this general accepted accounting principles or the GAAP. We have 14 odd accounting concepts starting from the equity concept, then we have the money measurement concept, we have the prudence concept likewise. Then we have conventions as well. So if we are not maintained, what will happen? It's difficult to compare. A company may be use straight line basis, the other company may use reducing balance basis. Sometimes another company may use accelerated depreciation method. So it's difficult to compare the figures by using this common size analysis in that case. If a particular company is using FIFO method, if another company is using weighted average method, then the inventory figures may be changed. So it's unable to identify the differences between these accounting principles, concept and conventions, as well as to make a correct decision by using this common size analysis. Then the next one, seasonal fluctuations. So you know that, right? So each and every industry, there is a season. This season may be not depend on the weather. This season is depend on the industry itself. This common size statement failed to convey the proper records during the seasonal fluctuations in various components of sales, assets, liabilities. The seasonal fluctuations may have a significant impact. Just take the sales figure. In Sri Lanka, you know that in the garment sector, right, in the apparel industry, in the April, with the new year, there is another season is booming. With the Christmas, there is another season. So, this common size analysis is failed to identify these seasonal fluctuations. Based on these seasonal fluctuations, asset proportion may be changed. Sometimes to cater up with the April season, they may have to store more inventories in the March and April. Sometimes to cater up with the New Year and Christmas, they may have store more inventories in October and November. So asset composition also have an impact with the seasonal fluctuations. So this may be ignored in the common size analysis. Then the fifth one, effect of window dressing in the financial statements. So this common size analysis is ignored the effect of window dressing in the financial statement. So these common size statements fail to supply the real position of sales, assets, liabilities due to this evil effect of window dressing. Then the sixth one and the final one, it failed to recognize the qualitative elements. Qualitative elements, which means these elements cannot be measured in numbers, such as quality of works, customer relations, goodwill. So these factors may be not reflected in the common size analysis. So let's see these financial statements. So this is the PQR company's income statement for the year ended 31st, 2018. So you can see different line items in the income statement. So now in the next slide, I'm going to show you how we have prepared the income statement with this PQR figures and how we can create the common size income statement. So in the common size income statement, what we are going to do? Here we are going to do is we are going to take the sales as the main figure and we are going to divide each and every item in the income statement compared to the sales. So here you can see the net income, right? 1 million. Then cost of goods sold 5 lakhs. So the common size income analysis, take this 50,000, 5 lakhs, and we are going to divide it with the 1 million. So we can take the 50%. So how we are going to prepare this? So first I am going to copy this one into the Excel file. So you can see the Excel file as this. So here I am going to prepare the vertical analysis of income statement. For that, what I'm going to take, I'm going to take a sales figure of 2017 and I'm going to divide it with the same figure. Then you can see the net sales figure in 2017 in the comparative analysis is 100%. Then I'm going to take the cost of sales figure and then I'm going to divide it with the net sales. So my cost of goods sold is 50% of the net sales. Then I'm going to take the gross profit margin. I'm going to take the gross profit margin absolute figure and I'm going to divide it with the net sales. So as a proportionate to the net sales, gross profit margin is 50%. So likewise, I have to take each item compared to the sales. So here what I'm going to do is I'm going to fix or absolute the sales figure. Then I'm going to drag it up to the end of the income statement. So you can see each and every item compared to the net sales. So can you see? So I am going to take the net sales. I'm going to divide it with the net sales figure because in the vertical income statement, each and every figure is based on the net sales. Then for each and every item, I'm going to divide it with the sales. So I'm going to take as a percentage of sales, what is the proportion of cost of goods sold, then gross profit margin, sales and admin, depreciation, operating profit, interest, likewise. For that, what I can do is, first I'm going to take the particular figure, then I'm going to divide it with the sales figure, then I'm going to absolute the sales figure. So then it's convenient for me to prepare the vertical income statement with the lesser time. So now let's move on to the PowerPoint so you can see how can I write with this proportionate. So here I have given the 2018 income statement figures. So by using an Excel sheet or by using your calculator, you can calculate the 2018 common size income statement. So now let's see the interpretation. So here, what are the changes you can identify? So here you can see cost of goods sold. 2017, it is 50%, but 2018, it has been increased. So what are the reasons? So we have to interpret what are the reasons for this. Then, because of this change, 2017, even though the gross profit margin is 50%, this has been reduced to 41.5%. So the major reason is what? The major reason is increase in cost of sales. So you have to reason out. You have to interpret what are the reasons for this. Then the sales and administrative expenses. Compared to the 2017, this company has been able to reduce its sales and administrative expenses. However, compared to the 2017, the depreciation expenses has increased. Why the depreciation expenses has increased? This may due to acquisition of a new asset. That's why the depreciation proportion has been increased. So then you can see the interest portion. So here, compared to the 2017, interest proportion has been also increased. Sometimes this may be due to a new loan or short-term loan. So since our profit is increased in 2014, right? So this earning before taxes here in 2017, you can see it as 14%. But in 2018, it is 4%. This may be due to the reasons of decrease in selling and expenses and increase in depreciation. So our profit before tax figure has been reduced in 2018. However, tax is compared to the 2017 has been reduced. Why tax has been reduced? We know that if the profit is decreased, normally the tax figure also decrease. So you can see the net profit. So now we have to give the interpretation for these changes. First, you have to prepare the common size income statement. Then you have to identify the key changes. Then for each and every change, you have to give the reasons. You have to interpret these changes. So let's see. So this is the interpretation. The cost of goods sold for the business has increased in 2017 to 2018. So the cost of goods sold usually include direct labor cost, direct material cost used in the production. So one reason of the cost of goods sold has gone up is that sales have gone up, right? Because of the increase in sales, we have to put more cost for the materials. To cater up for the increase in sales, we have to put more labor. Therefore, the cost of goods sold may be gone up. Or the cost of direct expenses and purchases may have gone up. Sometimes there may be a direct taxes. Sometimes there may be higher rates. Sometimes there may be higher import duties. Therefore, the purchase cost may go up. As a result, cost of goods sold may go up. So this suggests that the firm should try to find quality materials at lower cost. So this is the suggestions. So we are going to suggest the firm, you have to find better quality materials but at lower cost. Don't go for higher prices. So we are going to suggest that particular company. And the company have to lower its direct expenses as possible. So the company have to try to manage their idle time. By managing idle time, they can reduce the direct labor variances. By managing the abnormal losses, they can manage the adverse material usage variances. So they can increase their performance by managing these direct costs or direct expenses. So the next one, the operating profit or the earning before interest and tax is the next point to be analyzed because it shows the health of the business firm's core businesses. Operating profit has dropped from 17% in 2017 to 7.6% in 2017. So you can see it's in 2-digit percentage, that is 17, and it has been dropped to 1-digit percentage, that is 7.6. So you can see there is a large drop in 1 year. So what are the reasons for the decrease? So one is the cost of goods sold dropped, while both selling and administration expenses and depreciation expenses has increased. So the firm may have brought new fixed assets, or they may have spent more money on sales commission, or may have increased new administrative cost for hire or acquire new employees to the organization with a bigger package. The firm's selling and administration as well as depreciation cost may go up. As a result of these costs, the operating profit or the earning profit before interest and tax has been decreased. So you have to reason out what are the reasons for this drop. Then there is less money for the shareholders or any other goals that the firm management want to achieve. Why? Because this operating profit has been reduced. It is also watched closely by lenders when assessing the company's credit risk. So if the operating profit is low, which means the company is unable to manage its business. If the operating profit is low, then they may have to pay lesser amount as earning per share. If they are going to retain the shares, if they are going to pay it as a dividend, they will pay lesser amount as the dividend payout ratio. Then it will be a threat for the shareholders. At the same time, if the organization doesn't have the profit, then what will happen in the short run? The company's liquidity is in a greater risk. So the lenders, bankers, creditors, they are going to closely assess the company's credit risk based on these operating profits. The next point of the analysis is company's non-operating expenses such as interest expenses. Interest expenses is paid on the company's debt. The income statement does not tell us how much debt the company has. But Since the depreciation increase, it is reasonable to assume that firms brought a new fixed asset and used its debt to finance it. So we have said our depreciation expenses gone up. Why the depreciation expenses gone up? Because we have acquired the new asset. So to acquire the new asset, what we have done is rather than using the company's own fund or the own cash, they have taken it on credit basis. Therefore, for the higher credit, sometimes it may be a bank loan, sometimes it may be leasing, they have to pay higher amount as the interest expense. So as a result, our interest expenses has been gone up. So this firm may have purchased new asset at the birth time since the cost of goods sold was rising during the same period. So we can see that the cost of goods sold has been increased. Even though this has been increased due to this purchase of new asset, our performance may be gone up, which means asset turnover may be higher. As a result, performance may be increased in future even though it has been a small reduction in the short term. So we have to suggest that. Then the final one. Net profit dropped from 8.4% of sales to 2.4% of sales. That is, right, precipitous decline in 1 year. What do you mean by precipitous decline? So it is a great decline in 1 year. If the company has shareholders, they will leave them a questioning what went wrong. So if a shareholder is there, they may wonder what else is going to happen to our company. Why the top management or why the middle management or the front level employees haven't taken necessary action for this large drop in the net profit. So they may be questioned out. So it is a clear signal to the management that it needs to be handled, right, on the increasing of cost of goods sold. So the management have to see it when there is a decrease in the gross profit. So they have to monitor it. But this company's management has taken necessary action for this one. So you have to suggest them, they have to keenly monitor it, right, before it is going to out of control, right? If there are any fixed asset, they can sold these old assets. So by selling this old asset, they can purchase new assets or they can lower the depreciation and interest expenses on debt. So we are going to suggest them. So if the company have old assets, sell them, buy new ones. So by buying the new ones, we can increase the performance of the company. So by selling the old assets, we can pay out for the debt. By paying out the debt, we can reduce the interest expense. So you can suggest them. So you can see this enable to the firm to build up a better position in the 2019 income statement. So likewise, you have to interpret line by line and you have to reason out what are the reasons behind it. So see, now I want you to prepare this ABC company's income statement and you have to interpret, right, the reasons for the changes by using the vertical analysis income statement. So Let's see the answer in the next slide.